Is $100,000 the most important milestone for building financial freedom with dividends? Well, Charlie Munger once said that reaching a six-figure investment portfolio is the hardest part of wealth building. But once you get there, compounding takes over and does most of the work for you. Warren Buffett also emphasized the power of passive income, famously stating, "If you don't find a way to make money while you sleep, you will work until you die." So with that in mind, today I'm going to break down why $100,000 is a critical milestone for an investment portfolio where you're trying to focus on passive income. 2, how to construct a dividend portfolio that compounds into a monster dividend income portfolio over time. And 3, provide you with a model portfolio with my top picks for long-term high-yield dividend investing. So if you're serious about reaching financial independence and living off of dividends, then you need to watch this video until the end. And if you appreciate deep dive dividend investing insights like this, make sure to smash that like button and subscribe for more content like this in the coming days and weeks. Thank you very much. So why is achieving $100,000 portfolio such an important landmark to meet? Well, first of all, it's where compound interest really becomes more powerful. At $100,000 in your portfolio, your investments begin generating meaningful returns. With an average 10% return per year, for example, your portfolio could grow by $10,000 annually without you adding another dollar of your own external hard-earned income. That means your portfolio is working really almost as hard as you do. 2, your investment income starts covering real expenses. If you build a high yield dividend portfolio paying an average of say 6 to 7%, you're now generating $6,000 to $7,000 per year in passive dividend income alone. That's not even counting capital appreciation. That could cover your rent, your groceries, or a vacation without touching your principal. 3rd, you stop relying entirely on your paycheck. So once your investment returns start matching your annual savings, you've reached financial escape velocity, or your money is now growing just as fast as you can add to it. But here's the problem. Not all dividend stocks are created equal. So if you invest in the wrong stocks, your dividends could be cut and your portfolio won't compound effectively over time. So with that in mind, let's go over the 5 golden rules for building a dividend portfolio that will last a lifetime. The first rule for building a monster dividend portfolio is that you need to invest in durable defensive businesses. So if you're going to rely on dividends for retirement income, you need companies that can survive recessions, inflation, and economic downturns. You want to avoid those companies that are too cyclical or sensitive to economic slowdowns and instead focus on essential industries like energy infrastructure, consumer staples, healthcare, utilities, etc. Second thing you need is a strong balance sheet. These are the best dividend stocks to have because they have low leverage ratios, strong investment grade credit ratings, which give them access to capital at a fairly attractive rate. And 3rd, significant cash and liquidity on hand. A company with too much debt might have to cut its dividend if interest rates rise. Just look at what happened to VF Corporation and 3M as 2 examples of long-time dividend payers that had to cut when meeting with hard times. 3rd, the dividend must be well covered by cash flow. A company should generate more than enough free cash flow to cover its dividends. So if the dividend payout ratio is too high, that's a big red flag and the dividend may not be sustainable. Or if the company has to borrow money to keep paying dividends, you're really one step away from a dividend cut. That's a pretty dangerous place to be living. 4th, your dividend yield must align with your goals. Your target yield really that you want to get from your portfolio really depends on your investment timeline. If you have only a few years to retirement or you're in retirement now, you probably want to target a higher yield. Now you don't want to go too high because that may prove to be unsustainable. Those dividends may be risky. But if you can probably target a 5 to 7% yield in the current environment and be just fine if you're intelligent about it and you pay attention to those first 3 rules. And that should generate income fairly quickly for you and get you where you need to be within your time frame. However, if you have 25 or more years, you could start with a much lower yield and instead focus more on dividend growth to get that long-term compounding effect to when you're retiring, your yield on cost is going to be substantially higher. In the meantime, you're going to get a lot of growth, capital appreciation on top of that. And that leads me to the 5th and final point. Your dividend growth must meet or exceed inflation over time. If your dividends don't grow, inflation is going to erode your purchasing power over time and your investment strategy is going to be unsustainable. So let's say you need to live off of $50,000 a year in passive income from dividends, add that to whatever pension or social security or whatever other retirement income sources you have, and you think that's going to be enough. So that means, and let's say you have a $1 million portfolio, that means you need a 5% target yield. However, that's not going to be enough. You're going to need that to grow at a rate that meets or beats inflation. So say 3 to 4% to be safe over time based on where current inflation rates are and where they could be. That's what you're going to need over time to be able to sustain that $50,000 purchasing power. Now, Again, maybe you can get that multiple ways. Either A, you can target a higher yield, so maybe you want to get a 6% weighted average yield, and that remaining $10,000 you're going to reinvest in your portfolio in combination with some dividend growth. That additional dividends from those $10,000 are reinvested dividends plus the organic growth in your existing shares. That will keep up with inflation. Or you may just go with the standard 5% yield, but you want to make sure that the expected growth rate from the 5% yield is going to be exceeding inflation. You really want to exceed it because in case there's any underperformance or hard times that slow the growth rate or higher inflation than you expect, that gives you a nice margin of safety. So maybe with that 5% yield, you're going to want to target maybe a 5% growth rate weighted average for the portfolio. So now we've covered these 5 yields. Let's build an actual $100,000 dividend portfolio that follows these principles. So first of all, you can follow a simple and diversified approach of just investing in a couple of high quality, reasonably priced ETFs to get the job done. So you can of course have a core holding like the Schwab US Dividend Equity ETF, that's ticker symbol SEHD, offers a yield of a little bit over 3.5%, invests in over 100 blue chip holdings. It's grown its dividend every year since its inception. It grows between high single digits and low double digits per year on its dividend, so it'll easily take care of the inflation side for you. Then you can diversify that because it doesn't have a lot of mega cap tech exposure, so you can invest in a covered call ETF like a JP Morgan NASDAQ equity ETF that is ticker symbol JEPQ, has a reasonable expense ratio, has a high single digit yield with monthly distributions due to employing a covered call strategy on top of its underlying NASDAQ-ish and NASDAQ-like portfolio. Gives you that mega cap tech exposure along with the monthly attractive distributions. You can invest in midstream infrastructure like the Alerian MLP ETF that has an over 7% yield, expected to grow that yield at a pace that beats inflation moving forward. Again, gives you that exposure to some blue chip MLPs without having to deal with the K1 tax forms. Again, that gives you diversification to another sector that's not very prevalent in SCHD. You can also invest in BDC ETFs like the BIZD ETF, and those hold portfolio of BDCs that pay very high yields, 10% plus yield. Probably not going to get as much growth there, but with a 10% yield, you can reinvest some of the excess yields, kind of like what you'll do with JPQ, because that really won't grow very much either because it's a covered call strategy. But yeah, BIZD, another one that doesn't really show up in SCHD's underlying holdings, that can give you further diversification and a nice yield enhancer. And of course, you can invest in REITs because there's not much real estate in SCHD either. So like you have the Vanguard Real Estate ETF, VNQ, which is low cost ETF invested across a broad smattering of blue chip blue chip REITs. It gives you a nice 4% something yield with some growth over time. So that's a nice diversifier. You can also invest in like a preferred stock ETF, for example, the InfraCap REIT preferred ETF, PFFR. It's got a fairly low expense ratio at over 7% yield. Got the safety of real estate backed preferred portfolio, diversified portfolio of those. So that's a nice, relatively low risk, high yield. You can reinvest again some of the excess proceeds and get some growth on top of that. So this is kind of a portfolio, for example, depending on exactly how you weight everything, we give you a mid to high single digit yield while still providing significant diversification and growth that should keep up with or beat inflation, especially if you can reinvest some of the excess yield. However, if you want higher returns and potentially higher dividend growth in aggregate, but if you want higher returns, you can invest in hand-picked individual dividend stocks that can outperform some of these ETFs. And of course, you could, if you're like me, you'll probably want to have at least 20 to 25 stocks in that portfolio, again, to give you that diversification. In case you get 1 or 2 of your investments wrong and you get a dividend cut here and there that you didn't expect. Plus helps keep the volatility minimal, even though you shouldn't care about volatility as an income investor as much. It still can rattle your brain. So have that diversification. Or an alternative is just hold some of those ETFs and supplement them with some individual stocks. That's not a bad way to go either. And I've talked about some of these individual stocks in other videos, and some I like are like Enterprise Products Partners as an MLP, for example. You can get a BDC such as like Blackstone Secured Lending or Golub Capital BDC or Morgan Stanley Direct Lending or Aris Capital Corporation or Main Street Capital. Those are some of the big blue chips out there that are pretty good. For REITs, Realty Income's hard to beat, but there are others as well that are similar to that, but as a huge triple net lease REIT with a very strong credit rating, a good yield that's well covered and growing. That's a great pick from the real estate space. You get diversified infrastructure plays like Brookfield Infrastructure Partners or Brookfield Renewable Partners. Those are good ones as well that check all these boxes. So, in conclusion, reaching $100,000 in your dividend portfolio is a huge milestone. Once you hit 6 figures, your compound interest really takes over and plays a more visible role in driving your overall portfolio growth over time. A strong dividend portfolio can generate between $6,000 to $10,000 per year in passive income, even with just a $100,000 sum in there. And that can really go a long way towards meeting some of your living expenses and making life a little less burdensome. And so with consistent reinvestment, this portfolio can turn into a monster dividend snowball that eventually can fund your entire living expenses and enable you to retire on dividends. So with all that said, what's your ideal dividend portfolio? Would you rather invest in ETFs like SEHD, or do you prefer handpicking individual stocks, or do you like a mix of the two? Let me know in the comments below. And again, if you got value from this video, smash that like button, subscribe for more dividend investing insights. See you next time. Thank you so much.